Okay, we're starting the Finance Committee meeting for December 19th. We have, could everybody state their name? Who's here for the meeting?
Tanya Bell.
Julia Olafson.
Ray Cooper.
Kathy.
Yeah, you too.
Steve Rittenhouse.
And Kathleen Haynes, we just heard that. Okay, so welcome everyone. Today we have the audit review. I'm going to have Ms. Haynes introduce Representative Haley, who's here today.
Yeah, Chris Hurd, he's going to be going over, he's the partner over going over the highlights of the
Hi.
Hey.
Everybody. Thanks for being here. Glad I can present the June 30, 22 financials. Just about ready to wrap these up. Here to kind of present the overview of what we did and what the results are. I always like to start with just a quick overview of what we do. We are the independent auditors for the school district, so we are not involved in any management decisions, any of the bookkeeping. We're really coming in to sort of kick the tires on the books, make sure everything's properly stated, and then we compile the financial statement based on the information we get from your business office. The way we always start the process, we come in with a very lengthy list of documents. We want to see everything from bank statements and reconciliations to individual invoices to the W-2 for every employee of the school district. So it is a very comprehensive look at a variety of financial items. And from that, we are able to render an opinion on the financials. I do have this little 5-page summary that hopefully you all have. That's kind of what I'm going to stick to. So on the first page there, under financial statement audit, the auditor's report expresses an unmodified opinion on the financial statements. So unmodified opinion, also known as a clean opinion, it's the best opinion you can have on your financials, is what you want to have. What that means is that in our opinion, the statements are free of any material misstatement. They comply with generally accepted accounting principles. They comply with all GASB pronouncements. That's the Governmental Accounting Standards Board that comes up with a lot of the government-specific rules. They're the reason that this financial statement is 100 pages when it should probably be only 50 pages. No scope limitations. Again, we come in with a very lengthy list of items we need. We did receive everything that we needed. The opinion does have an emphasis of matter in it, which is exactly what it sounds like. It's our, as the auditors, ability to emphasize a matter to a reader. There are certain things that, in our opinion, you have to have an emphasis of matter for. We did have a couple things this year. And again, they're not bad, but they're just letting a reader know, hey, this was a significant event that happened in financials this year. Two things. One, we implemented a new GASB standard 87 for leases, which just changes the way we have to report any lease receivables or lease payables. So it did add some receivables, payables to the financial. There's also a new lease footnote in there that just breaks down some of the information. There probably added another 5 pages to the financial this year. So again, like I said, the GASB students tend to add on. We also have an emphasis of matter in there for a restatement. During this year, the school district went and did a asset appraisal. They got an asset appraisal company to come in and sort of look at the value of buildings and vehicles and equipment and all those sort of things. So in our capital asset footnote, you will see last year's balances and then a restatement that comes from the asset valuation that was done. So we're also pointing a reader at the statement to that as well.
I'm sorry to interrupt you.
Yep.
So let me just see if I understand that. So the assets, their value and depreciation and all that stuff, they were like at some point when they were purchased for the school, they had a valuation, and we were going along as the years go, and then this year we did a restatement of a lot of those things. So there might have been some deltas on those items, different than what it was last year, just because, like, say we'd owned it for 15 years, and it was a little different.
Yeah, in the financial statement, if anyone's got it, it's page 13 of the financial. You have $130 million of assets cost. The restatement on that was $1.3 million.
Okay.
So really, really small. Now, what happened was buildings went down 8 million, equipment, furniture, and fixtures went up 8 million.
little,
So
yeah.
a lot of it was just moving around within the buckets.
Okay.
But as far as overall cost, I was actually really surprised. I've seen other school districts and municipalities go through asset appraisals and have a much bigger difference
I
than
see.
a net 1.3. So what that tells me is overall, somewhere over the last 20 years since GASB 34 came along and really required a lot of these new asset models, some people might have put some stuff in the wrong bucket
Okay.
along the way. But overall, I thought, the cost valuation was really accurate.
All right.
Now the depreciation, that the accumulated depreciation, we did pick up $5 million there. To me, that probably goes hand in hand with the fact that we moved some assets from buildings, which is typically a longer depreciation life, down to furniture and equipment, which is a shorter.
It's shorter. Okay.
So what happened was that accelerated accumulated depreciation, which caused that $5 million increase. That's like a non-cash event. You know what I mean? That's
I do.
sort of
Okay.
bookkeeping. So
Okay. I'm sorry to interrupt.
no, that's fine. I'm happy to have anyone interrupt. If there's a question, we'll just tackle it as we go. But
Okay.
yeah, so that was the restatement, part of our opinion. No issues of non-compliance, no findings. One thing we do is we do look at the internal controls over a variety of financial aspects that the business office handles. How are they processing disbursements, receipts, payroll, bank recs, journal entries, basically anything you can think of that has to do with the finances. We look at the internal controls, policies, procedures. If we found anything that we felt was a significant deficiency, something that needed to be corrected, we would be required to communicate that. We didn't have any of those issues this year. Overall, one of the things I always look at that might lead to those deficiencies is journal entries, errors that we find when we're putting together the financial statement. I think we had maybe a half dozen this year, and some of those even came from that asset appraisal I mentioned. Some of that hit food service. So some of it came from that GASB 87 implementation as well. So very few journal entries came out of our audit, which tells me that I'd be pretty confident in saying that I think you guys are getting pretty good records on an ongoing basis throughout the year. We really didn't have a lot of corrections went through the audit process. The Uniform Guidance Audit, which is also known as the single audit, is the audit of federal awards. So this is all the federal money that you get, your Child Nutrition Cluster, Title I, IDEA, all the COVID-19 money that came through. We are required to audit some of that money, usually at least 20% of the dollars that you get in, we have to audit. This year we did look at the Education Stabilization Fund, which is now that new ESSER 1, ESSER 2, that COVID money that we've been getting this year. So we did look at that. We did expense testing there and concluded that it looks like the spending there is being spent on what it should be spent on. The next page of that, I always like to point to some of the big estimates that are in the financial statement. I sort of mentioned before, capital assets, cost of the assets on the books is about $128 million. You had about just shy of $6 million of depreciation this year. At the end of the year, accumulated depreciation is about $74 million. So you're a little further than halfway through the life of your assets. Net pension liability, big drop there, went from $80 million last year down to $65 million this year. So the net pension liability, this is your share of the PSERS pie. It is about an 18% decrease. So what happened here was, with PSERS, you're always on a one-year look back. So even though this is a June 30, 22 financial statement, you're using PSERS information from June 30, 2021. So what happened in PSERS in the 2021 year? Initially, you're about starting that year, you're 3 months into the pandemic. So there was a big market drop at the beginning of the end of the 1920 year. And then when we got through the 2021 year, the markets really rallied and did very well. And that's what happened in PSERS for that 2021 year. They had very good investment gains and brought their liability down. Their liability went from about $49 billion in the red and about $41 billion in the red. So it's about a 16, 17% decrease. That matches your 80 down to 65 million here. Probably won't go that way. When I actually looked before I got here, it's already up, back up to about 44, 45 million. So
Yeah, let's not talk about that.
it's gonna pinball with the markets. Net OPEB liability, pretty flat, between $7.5 and $8 million each year, and the compensated absence is about $800,000 each year there. The next table, revenue composition for the governmental funds. So this is pretty much everything except food service. Total for last year, total revenues was $59.3 million. It's up to about $62.9 million this year, so about a $3.6 million increase in revenues overall. Biggest chunk of that was in your local sources. This is mostly your taxes. Biggest piece of this is about $35 million in real estate taxes. Real estate taxes were up $1.8 million from the prior year. $400,000 increase in EIT. It's about 10-11%. I can't explain it anymore. EIT just for everybody. Everyone I go to, Montgomery County, Berks County, Chester County, it just seems like every year EIT goes up, 10-15%. So that was a nice little gain there. State sources very flat, about 19.3, 19.5 million a year. And then your federal sources, that did increase significantly from 1.1 million to 2.1 million. That's going to be that new COVID-19, that ESSER money that's in there this year that was not in there last year. The bottom table there, the expenditure composition for your governmental funds, $62.5 million this year. It's up from about $59.9 million last year, so about a roughly $2.6 million increase. Instruction went down a little bit. Support services went up a little bit. The big change was debt service. Doubled from about $3.2 million last year to $6.2 million this year. The reason for that, you guys did a bunch of refundings last year. That tends to sort of stall principal payments a little bit. And that's kind of what happened. You did some refundings. It kind of slowed down the principal payments last year. Now you're getting back into a typical principal payment cycle. Next page, bonds payable. Not really much to say here. $69.5 million of outstanding debt last year, down to $66.4 million this year. You have about $5 million in principal payments this year. The next table, if there's any one table I'd say is the most important in here, would be this one. This is fund balance. This is, I would say, sort of speaks to the financial health of the school district. What fund balance is if you take all your assets, pay off all your liabilities, it's what's left. So kind of working up from the bottom. At the very bottom is food service. It's that gray line. Went from $260,000 last year. 262 years ago, 330 last year, jumped up to 1.2 million this year. The reason for that, and this is consistent with every other school district I worked on, the federal government was nice enough to fully subsidize all the meals you served for 21 days a year. So it really brought every district on that. The fund balance doubled and tripled as a result. The orange line, which is the middle line there, this is your capital projects funds. 3.4 million last year, 3.4 2 years ago, 4.3 last year. It's up to 5.1 million this year. So this is money you've set aside for capital project improvements, things of that nature. And the line at the top, the blue line, that's your general fund, was 7.8 million last year, down to 7.4 million. Keep doing it. 7.8 2 years ago, 7.4 last year, and 7.2 this year. 7.2 at the end of this year represents about 11% of your annual expenses. If we were to convert it to months, your fund balance would cover about $1.3 million or 1.3 months of expense. It's a little on the low side. Typically, I see closer to 2 as sort of the floor. And of that 7.2 million, I believe only between 3 and 4 million is unassigned. Everything else is sort of restricted or assigned for a future purpose. So, my takeaway there would be I never like to see fund balance go down 3 years in a row. I don't like seeing that. I usually like to see that general fund line either flat or a little bit of fluctuation, but that would definitely be something I'd be keeping an eye on over the next year, making sure that general fund balance doesn't continue to decline. And then the last table, I put this in all my presentations. Some, believe that about what we do from an audit perspective. Your balance sheet, your assets, we confirm your cash with banks. We do a lot of subsequent testing on your receipts. Make sure all your receivables are properly stated. On the payable side, we'll do the same thing. We'll look at a lot of payments subsequent year and make sure they were booked in the proper period. We confirm debt, you know, your pension, OPEB liabilities, we confirm that stuff with the state. On the revenue side, again, we do a lot of confirmation, tax collector confirmation, EIT confirmation, a lot of your grants we confirm with the state. And then we get down to expenses where there's not really a lot of easy ways to do that, so we do a lot of computerized testing. One of the things we do is we get your general ledger business loans. That's the electronic report of every individual transaction that happens in the school district during the year. We run it through our data extraction analysis tool, and we can do a variety of things. One of the things we do is Benford's Law, which is this first table here. It says in any large randomly occurring population of numbers, first digit will be 1 about 30% of the time, will be 2 about 22% of the time. It drops down from there. So we do run your information through it and make sure that it's following this mathematical law. It always does on 1 digit. I've done this hundreds, if not thousands of times in various schools and municipalities. I've never had an issue with the 1 digit. Then we run 2 digits. That's when we get some stuff popping up. Typically, we did run it here. It's 2. It would look like gibberish to print on this piece of paper, but we did have a few items that popped up there. It was always recurring payroll type items. Those things that happen every 2 weeks. We do a bunch of other things. We list at the bottom. We do pivot table analysis. We lay out your data month to month. Look for any unusual spikes or valleys in activity. Aim our testing there. This was our second year doing your audits. We were also able to compare this year's activity, last year's activity. Again, look maybe July of 21 makes sense compared to July of things like that. Predictive analytics will take your last 2-3 years of data, come up with an analysis and expectation of what we think this year is going to look like, and compare it to what actually happened. And again, test anything that doesn't fit our expectations. We look at all your W-2s. We look at journal entries that are run through the system. We look at your vendors, try to make sure that the vendors that you're using make sense for a school district. We look for duplicate payments. We didn't find any of those this year. So, there's a variety of things we do, especially in the expense area, and it's all about risk-based approach. We're not coming in and looking at the same expense accounts we did last year, the same vendors we did last year. It's a risk-based approach where we're really taking the data and just kind of letting that take us where we're doing. So, just a little bit of behind the curtain what we're doing with the audit. That's really all I got. That's the end of my presentation. I think I covered everything I wanted to. I'd be happy to field any questions if there are any.
I just have one question.
Sure.
At the beginning, you mentioned the new standard 87. Would you be able to elaborate on what those changes are?
Yeah, it's a new lease standard. And if you have any contract where someone else is either using your asset or you're using someone else's asset, it falls under this new lease standard. So in the past, there was a differentiation between operating leases and capital leases.
Okay.
So an operating lease would be like your copiers. Typically, no one ever owns their copiers. You get a 3-year contract with Canon or Xerox. At the end of it, they take the copiers back. You do a new contract, you get your copiers. Mm-hmm. So that was never something that had to be put on your balance sheet as a liability of, hey, we have to pay Canon down the road or Xerox, whatever it was. And it was never booked as an asset because it wasn't your asset. It was their asset, you're just borrowing.
So in the past, the only ones would be like for actual like buildings and physical and cars and things like that?
Yeah, it would be buildings, it would be computers, it would be copiers, it would be vehicles, anything.
It's your office equipment, it's right, it's your pencils, papers, it's office supplies.
The standard actually went so far that if you use an outside busing company, and this was something that we did not, if you used an outside busing company, in theory, you're using their buses.
Mm-hmm.
So that would be a lease.
Right.
Where you should capitalize those buses on your books. Mm. Now, we were able to look at the contracts and the way a lot of them are worded for the school districts, at least in this state. Keep in mind, these are federal, countrywide rules. Because they're variable payments, because you pay your bus contractors based on how many hours they're driving or how many routes they're driving, you don't pay them if you close for a week because of snow.
Right.
Because there's that variable aspect, we didn't have to do that here.
Okay.
If it was a flat we're going to pay you.
But you have to make that determination
yeah,
with
we have-
every one of our contracts,
Yeah,
okay?
we have to do that. We had to read through all those contracts. Food service, there was discussions, at some GFOA conferences that if you have a Chartwells or a Food Nutrition come in and provide your food service services, are you leasing them your cafeteria space? So there's a whole bunch of wrinkles with this.
Okay.
And in the end, the other wrinkle to this is if you're going to buy the item at the end, I think you guys had some computer leases. But they're actually called lease purchase obligations. So if you read the contract, you're not going to return those laptops at the end. The way it works is you make those payments and then you're done. You own them at the end. There's no, hey, we're going to have, I've seen some Apple contracts where it's like, well, at the end of the contract, we're going to look at the fair market value of the laptops and then we'll decide what they are.
What to
Those are
do,
leases.
yeah.
Here, you're going to own them at the end. So those are not leases, even though the contract says leases.
Right.
Those are actually, they're a new line in your debt footnote. I called it lease. I didn't use the word lease. I think it's a finance purchase obligation is what I call it.
Okay, and that's part of these footnote changes from this year?
That is
Okay.
part of the footnote changes. I want to say footnote F, probably wrong. I. So footnote really H and I. H is a new footnote for right to use leased assets. So we have a $100,000 asset that's due on your book for computers that were really considered leases based on the wording in the contract.
Okay.
There was another $800,000 that are that finance purchase obligation. So for the $100,000 that are leases that you lease, you have a $100,000 asset and a $100,000 liability on a government-wide. Basically, they
Okay.
cancel each other out. Now you also have lease receivables for the building, because you have a building that you lease out office space.
Right.
So we had to go through, do a bunch of calculations there, come up with some imputed interest rates based on the real estate market here. It was a fun exercise.
Okay.
I don't have too many districts that have lease receivables, but you guys do. You have some space. I think there's also a couple sheds that you guys rent out as well. So that,
Stick around, we're going to talk about one of them. Sounds like fun?
Yeah, it was fun for me to go through the agreements, let me tell you. So if you look at Note I, there's actually 5 leases there, 3 for office space and 2 for buildings,
Okay.
shed. So that is another thing. Now that's a lease receivable, and then there's an offsetting sort of quasi-liability called deferred inflow that we put on your general fund. But again, not a big impact on fund balance because it really kind of washes out the asset.
I understand. Okay.
That was, we were talking before the meeting, that was quite the mountain climb this year, getting over GASB 87. And next year is probably the worst one. This was for physical assets. Next year is GASB, I want to say 96, 97. Subscription-based information technology. So any software that you guys have a multi-year agreement on, or even year to year because you're going to renew it, we're going to have to treat that very similar to leases and both assets and liabilities for that. So
Well, that sounds like fun.
that is the one that every school district I've talked to is really not happy about.
Have you guys discussed any requirements for record keeping that will involve for next year already, or are we?
Well,
We're trying to get through this year's audit before you deal with next year.
It's funny. The GASB has been so bad. I mean, we're getting hit every year with something. Last year it was fiduciary.
Okay,
activity.
so it's not the first time you've been to the
No,
drawing
it
board
was-
on that.
It was really probably January, February of this year at a couple of the PICPA and GFOA conferences where this one really seemed to come into focus. Now, the good thing is the subscription-based technology one echoes a lot of GASB 87, so I don't expect the learning curve to be as bad there. I did provide a spreadsheet as part of our audit that Kathy filled out to kind of summarize all the physical leases. It's going to be basically the same spreadsheet for the subscription stuff. It's going to be going through and what do we have, identifying those things, pulling all the contracts, and then we'll be reviewing all that.
Okay, I'm sorry to monopolize the conversation. Anybody else from the committee have questions?
Just as a heads up, we've already started working on that. I'm going to start putting that list together
Okay, fair enough.
to get it ready.
Yeah, okay, that's kind of,
It'd be better for,
yeah. If the record keeping changes, if there are any, are starting already, it'll make things a lot easier
It'll
next
make it
year.
a lot easier for the transition.
Okay. Any questions for me?
I just have a question about the general fund balance. So what's driving it down? Why are we only holding 1.3 months of reserve? So is it a revenue loss, is it expenditure, that we're not keeping up with what is it?
So over the course of COVID, those reductions were because we didn't increase taxes for 2 years, and then we would have had to raise taxes more to keep up. To keep that fund balance, we would have had to raise taxes more to keep that fund balance stable across those years. Is that fair enough?
Yeah.
And what kind of, so if we look at, then I'm late to the game, so what kind of operating cuts do we look at? What kind of program cuts do we look at? Where do we look at balance the ledger? Because we weren't raising revenue.
From a budget standpoint, I came in $200 and some $1,000 over the revenue that was for this year. And that was due to the not having the doctor. Not having the doctor,
Okay.
we lost $250,000 in revenue. So when I'm looking at,
In revenue?
Yeah, because
Access money.
we get that money from the
the
state.
access claims, once we have the doctor, he signs off on certain things that we're allowed to, and then we can claim those through access funds, but we did lose that money. So from that perspective, I generally try to keep the expenditures and the revenue. We'll come in a budget and we'll have that gap, but that's what that assigned fund balance is for, just in case something happens, or just in case we really make
Yeah.
use of every single expenditure.
And
During
last,
the year,
when we signed off on if we were bringing in that money this year from having a doctor, we would have been able to keep it flat, because you said it was around $200,000 difference between last year and this year.
Right.
We would have been able to, but that was not known in June that we weren't going to have that.
Yeah.
So that was that we were anticipating that we were going to keep it flat. I remember we had that conversation.
Right.
But that's an unintended.
$39.
Right. That was the intention.
Okay.
Yeah. But it's sounding like the recommendation might be, if it's possible, to even increase the fund balance, to give us about 2 months' worth of operating revenue in the fund balance. There is a target.
I know in business, I always like to keep a 6-month reserve.
Sure, and the target in our documentation, I can't remember what it is. Is it 5 to 8 unassigned?
5 to 8%.
5 to 8% unassigned. And
So that would equal what?
depends on whatever the year is and what,
We got 65 million times 8%.
And the unassigned right now is at the low end, like at 5.3 maybe?
Yes.
Yeah, so we wanted higher, but that was like the low end that we were aiming for. The 8 would probably push us to 2 months.
And 8% fund balance would be 3 months of
About.
yeah.
Yeah.
3 months.
It's a lot.
Payroll and all that.
And if there's interest, I'm going to have Kathleen send the full report to the committee members, right? Okay.
Yeah, the full report will be available after the year. I have the draft right now where it stands, and I can send that out to the committee members.
Yeah.
And then after the holidays,
We'll have the
copies,
full report
and
to
I'll
vote on.
Give everybody one.
Okay.
Yeah, but she'll send the draft to the committee members.
But the fund balance it's a major, like the unassigned fund balance is important, because if the state decides not to approve the budget, you could go 3 to 4, 5 months, 6 months, 7 months. You don't know when they'll approve the budget. We were in that position, I don't know how many years ago, but what I did was I refinanced all that debt, because all of our debt was due in August. I refinanced just like I would a mortgage.
That's what he was saying.
Pushed it right into February. I think it's our bulk payment. I think it's February or something like that. But that gives us time to get that tax revenue in on August 31st, so we're able to make those commitments and not worry about having an extravagant fund balance that makes us look like we have money to give away.
So we now have 6 minutes to cover 3 more topics.
It'll be quick.
I know. So, but I just want to, unless there's something like that you guys want to talk about other than that, but beyond that, I would like to thank him for his time.
Nah, I mean, I have some other questions, Jessica, but that's what we can start.
I think we can follow up. That's why I wanted you to have the detailed thing. Okay. Thank you so much for your time.
Sure. Thank you. Have a good night.
Take care.
Have a good holiday, but we'll talk tomorrow.
We will.
All right, so the next item is the negative balances.
Yes.
Okay, negative balances are right now at $5,300. We are less than halfway through the school year, which means that we're probably going to come in between $10,000 and $12,000 in negative balances for the cafeteria. That's all.
So for the newer members of the board, this is a perennial problem. However, we've had government, state assistance. It was free lunch for 2 years now at this point. So this is back on the agenda because we're not getting that subsidized anymore.
Okay, we send out the letters and we started the robocall to make sure that they get nagged just as much as they can. But what I'm thinking is, do you want me to maybe use the cutoff as of December 31st? Maybe start sending collection letters for anybody in 90 pass? Is that okay? You already approved that GA
Yes.
Harris that we use. It's a collection company that I can take the ones and at least they spend their days calling these people.
Right.
They're getting their robocalls and they're also.
Are they still under contract for us for that? Yeah. So we're
Year
good.
after year.
Okay.
Keep sending stuff.
All right.
So if everybody's okay with that, we can get into that.
Okay.
All right,
What about you guys?
The last item I have is the transition lease. The transition house, which is the building 511 Chestnut
Right.
Street, is that house that we own. BCIU uses it for a transition house. They are paying $1,100 per month for the whole house. And they've been doing that for years and years and years and years and years and years. So this is an ongoing lease that it just re-ups itself. We have a 60-day notice that we can give them that we're changing it, which would be at the beginning of May to let them know. But I'd like permission to start getting the conversation started, and then I think the $3,000 or $4,000 lease would be more appropriate than the state of town.
I have questions about that.
But how do you feel about it? Is BCIU
Are you on this committee?
using the state? Recommendations?
So-
suggestions?
If you went to them and said, we're interested in increasing that lease to $3,000 or $4,000, and they say, well, we can't do that anymore, would we negotiate with them? Or would we say, forget it, I'll see you?
It's
up to the board.
How would you like me to handle it?
I would prefer that we allowed for some negotiation. But what do you guys think? If we go to them with a higher dollar amount and they want to negotiate something different, would we be open to hear what their ideas?
Did you get a triple net?
What?
Did you get a triple net lease?
Triple net lease?
Net?
They cover all the expenses.
We can negotiate it differently, like they already pay for all the utilities in that building. But it's been very, very expensive for us to do the repairs.
I know.
The repairs have been a major issue, so I mean, we can have them pay for all the repairs. And I really think the rent should increase.
I think that you can start the conversation, and then we'll see where it goes. If that's okay? Yeah. You guys all good with that? Just you start,
Yes.
to increase it, but yeah, not kicking them out to start with. Okay. Okay. Next.
The only other thing I had was that extra money. There was only $400,000 student net.
Oh, okay.
I
Right.
don't use that extra money.
Oh, right.
Hearing on the street that we got all this extra money.
Yes.
Well, we didn't raise taxes for 2 years, and it kind of nets itself out.
Right.
We use that extra money from the state. We didn't raise taxes, so now we're at an expense level that meets our revenue level.
Did
So we'll have a doctor and then itself next year.
Okay. Anybody have any questions for Ms. Haynes? Go ahead. I thought I heard somebody say something. Public comment?
Yeah, the net piece of it would be where we don't have to incur all the breakages that are occurring in the house because it's getting older. So the rent's obviously not covering. If you look at the total rent, the total expenses, we're in a net negative situation. So
Exactly.
one of the ways to correct that potentially could be, instead of increasing the rent, let's lose the liability of the wear and tear over the years. So just one of the things. I've never rented a building that wasn't net. It fell on us all the time. So
And that would definitely be one of the avenues that would have to change.
just
We could broach that subject, I guess.
Yeah, we'll just kind of, I'll broach
Think
the
about
topic.
that.
Yeah, no, I understand.
And then just coming out of this, we'll just need the approval on the audit, so we can take the vote.
Yeah. Okay, public comment on finance? We are having our finance committee meeting, the date that I can't think of, the 4th, the 5th?
Thursday, after the holiday. So,
That's the 6th, isn't it?
The 5th.
it's the
5th,
fifth.
5th,
Six, I think, yeah.
5th. Is it at 6 or 6:30?
Fifth.
Is it Tuesday the 4th? No?
Tuesday
Second
is the 3rd.
It's the 5th, Thursday the 5th.
Yeah.
At 6:30 we have. to
It's
start.
6:30. It's 6:30, yeah. Because the 1st is Sunday, and I had to remember that. Yeah. Okay. We're good. We'll adjourn. Any questions from the committee about the draft? Direct to Ms. Haynes, and when she answers us, she'll answer the whole committee. So, and that's fine. Okay. Thanks, everybody.